Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
We've got a really dense stack of sources for you this morning. We're pulling from CNBC, Yahoo Finance, and Bloomberg. And, they all seem to be pointing at a few key market narratives that are all about, extreme velocity, both up and down.
So our mission today is to cut through that noise for you. We're going to unpack what matters most. We'll start with the AI arms race, which is just getting more intense. Then we'll hit the pretty severe crypto correction that's happening right now.
And finally, we'll track those rising geopolitical pressures, particularly how they're influencing global trade and what U.S. corporations are doing about it.
Okay, let's jump right into that acceleration in AI. Because the speed, it feels almost unprecedented. We're not talking about small incremental changes anymore.
No, not at all. We are seeing major new models launched what feels like every few weeks, and it's fundamentally reshaping the whole battle, not just for enterprise customers, but for the hardware that runs it all.
And the big story this morning coming out of CNBC is Anthropic.
Exactly. They just unveiled Claude Opus 4.5. And if you've been following this space at all, you'll know this is their third major model release in just 2 months.
2 months? That's an insane pace.
It's staggering. And what's really important here is that this isn't just another general-purpose model. It has a very, very serious enterprise focus.
Okay, so who is this actually for? And what does it do that makes it better than the competition?
It's really custom-built for high-value, complex tasks. Think professional software developers, financial analysts, top-tier consultants, accountants.
The heavy hitters.
The heavy hitters. And the big claim, which the sources confirmed, is that it's state-of-the-art in something called agentic coding.
That's a term we're hearing more and more. For someone who's well-informed but maybe not deep in AI development, what does agentic coding capability actually mean?
It's a great question. Essentially, it means the AI can act on its own to complete multi-step goals. So instead of you telling it to write one line of code, you give it a complex task, like fix this bug in our system or integrate this new API. And the AI can figure out the steps, find the right files, generate the code, test it, and then implement the fix. All without a human holding its hand.
So it's acting more like a junior developer than just a tool. And they have proof for this.
They do. Anthropic is claiming Opus 4.5 outperformed rivals like Google's Gemini 3 Pro and even OpenAI's GPT 5.1 on something called the SWE bench test.
Yeah.
And that's basically the industry standard for measuring real-world software engineering ability.
Wow. So the metrics are shifting. It's not just about language, it's about execution. And it looks like the market is buying it. Anthropic's valuation just soared, didn't it?
It did. To around $350 billion following these huge multi-billion-dollar investments from Microsoft and NVIDIA. It just shows how much capital is flowing into the serious challengers to OpenAI.
Okay, so while Anthropic is cornering that specialized enterprise market, OpenAI seems to be going in a few different directions at once.
That's what the reports from CNBC and Bloomberg are showing. They're making a very aggressive push into the consumer space and the hardware space simultaneously.
We can see that consumer push right now. They just launched a shopping research tool inside ChatGPT.
Yeah, and it's a very tactical move into e-commerce. It can generate these detailed shopping guides that are tailored to your budget using up-to-date info from retail sites. It's a natural follow-up to their instant checkout feature from back in September.
But the hardware side, that's where this gets really interesting. It feels like a much bigger, longer-term threat to the whole mobile industry.
Absolutely. OpenAI's CEO, Sam Altman, he confirmed they have the first working prototypes for a dedicated AI hardware device.
And this is connected to their huge acquisition of Jony Ive's startup, IO, right?
That's the one, for a cool $6.4 billion earlier this year. And just to remind you, Jony Ive is the design genius behind the iPod, the iPhone, the Mac.
Yeah.
He has redefined consumer hardware over and over again.
And his goal for this new device is the real story here. He's aiming for a calmer vibe.
Yeah, Altman described it as moving away from the Times Square feeling of our smartphones, just constant distractions, to something more like sitting in the most beautiful cabin by a lake.
That is a fundamental shift in philosophy. It suggests a totally new way of interacting with technology.
It really does. We're talking about moving the main interface away from a screen that you're always staring at and getting notifications on to maybe an ambient, always-on utility that just sort of lives with you.
And if Ive pulls that off, the entire smartphone market, Apple, Samsung, everyone, is suddenly on notice.
If he does it in 2 years, like he's suggesting, We could be looking at a complete redefinition of consumer tech before the end of the decade.
But even with all this excitement around models and new hardware, the battle underneath it all for the chips that power everything is getting much, much hotter, and it's a direct challenge to NVIDIA.
It is. Reports across both Bloomberg and Yahoo Finance noted that NVIDIA shares took a hit yesterday. They fell up to 4%.
And that was on the news that Meta is thinking about a major infrastructure change.
A huge change. They're seriously considering using Google's custom chips, their tensor processing units, or TPUs, in their data centers. They might even start renting them in 2026 and go all in by 2027.
This is a massive win for Google's custom silicon strategy. I mean, they already have a deal to supply up to 1 million chips to Anthropic.
Right. But if Meta, one of the biggest AI infrastructure builders on the planet, also signs on, it proves that TPUs are a truly viable, scalable alternative. It cracks NVIDIA's near monopoly right open.
And the market reaction told that story perfectly. Broadcom, which helps Google design those TPUs, it surged 11.1%. It was the top gainer in the S&P 500 on Monday.
Investors are clearly rewarding any sign of diversification away from that single-source hardware.
So if we pull all these AI threads together, it does bring up that inevitable question. Is this sustainable? Is this a bubble? The Nasdaq had a great day Monday, up almost 2.7%. Alphabet rallied 6.3%. But there's a pretty big voice of caution out there.
There is, and we have to note it. Michael Burry, the investor famous from The Big Short, just launched a newsletter, according to Bloomberg. And its entire purpose is to lay out his increasingly bearish thesis on artificial intelligence.
And the way he did it is what's so interesting. He didn't just sell some stocks.
No, he deregistered his entire hedge fund, which was focused on shorting AI. And then he immediately pivots to this private newsletter to make the same case. The message seems to be that he thinks the market is so distorted that shorting it publicly is too risky. But he's doubling down on his core belief that these valuations are just not real.
It's a signal of extreme caution. You know, when a huge market rally is being lifted almost entirely by one or two mega stocks like an Alphabet or an NVIDIA, that's a very concentrated risk. If they stumble, the whole market could follow.
And that skepticism is the perfect bridge to the volatility we're seeing in other parts of the market.
Absolutely. Let's move from the hypergrowth in AI to the very sharp contraction in crypto. We've seen a lot of pain there this month.
Yeah, Yahoo Finance and CNBC have been all over this. The numbers are pretty stark. Bitcoin is on track for its worst month since June of 2022. It's hovering just above $87,000 right now.
And that's down about 30% from its October high, which is over $126,000. It's not just Bitcoin either. The total crypto market cap has just cratered.
It's fallen from $4.28 trillion down to $2.99 trillion since early October. This isn't just a small dip, it's a really painful structural correction.
So what's behind it? Analysts seem to be pointing to a few core problems.
They are. According to Yahoo Finance, there are 3 big interrelated issues driving this capital flight. The first one is basically institutional abandonment.
And the data really backs that up. Bitcoin ETF outflows for November, they're at $3.5 billion. That's the largest since February.
And BlackRock's iShares ETF alone saw $2.2 billion just walk out the door. That tells you the institutional money isn't just pausing, they're actively selling their Bitcoin.
Okay, so that's problem one. What's the second?
The second is all about the internal plumbing of the crypto ecosystem. We're seeing a big slowdown in stablecoin minting.
And for anyone who doesn't follow that closely, stablecoins are the lifeblood, they're pegged to the dollar, and provide liquidity.
Exactly. So when you see less of them being created, it suggests that new money isn't flowing in. In fact, capital is actively flowing out. Reports confirm about $800 million flowed from crypto back into traditional fiat currencies just last week.
So the money is physically leaving the building. Got it. What about the third factor, something about long-term holders?
Yeah, the third challenge is the behavior of what they call long-term holders, or LTHs. These are wallets that have held their Bitcoin for a year or more. The true believers.
And they're selling.
They're selling into this downturn. And the theory is that even these committed investors are trying to get ahead of the historical 4-year cycle that's tied to the halving event. They're de-risking, maybe anticipating that another big drop is coming, based on historical patterns.
It sounds like a pretty tough environment, though we should note Bitcoin and Ether did get a little bit of a lift on Monday.
They did. They were tracking that huge rally in tech stocks, which was itself fueled by renewed hopes for some help from the Fed.
Right. The macro picture. Markets are now pricing in a more than 80% chance of a quarter-point rate cut in December.
And that's after some pretty dovish comments from a few key Fed officials. Williams from the New York Fed, Daly from San Francisco, and Governor Waller.
That optimism is what sent the NASDAQ soaring to its best day since May. But we do have to present the balanced view.
Of course, Boston Fed President Collins came out with a very different take. CNBC reported she's leaning against a rate cut, saying she thinks policy is restrictive enough right now.
So the market is running on hope, but we're still waiting on the hard data like retail sales and the producer price index reports to see who's right.
Okay, shifting gears now, let's look at the geopolitical landscape. It's injecting a lot of uncertainty into global trade, especially with these escalating tensions in Asia.
Yes, the big focus right now is the friction between China and Japan over Taiwan. We saw President Trump get on back-to-back calls with China's Xi Jinping and Japan's Prime Minister Sanae Takaichi.
He was trying to preserve that very fragile trade truce. The whole thing was kicked off by remarks from Takaichi suggesting that Japanese troops might get involved in a Taiwan crisis.
And Beijing's response was not subtle?
No, it was swift and firm, according to Bloomberg. She pressed Trump very hard on the Taiwan issue, saying its return is an integral part of the post-war international order. At the same time, China started putting on the economic pressure.
Things like restricting seafood imports, issuing travel advisories. This has real economic teeth.
It does. And analysts don't see this getting resolved quickly. Beijing is demanding that Takaichi retract her statement, and for her that would be political suicide at home. So it's a real standoff.
It's a very delicate dance for the U.S. trying to keep things stable. And speaking of complex trade issues, there's a fascinating story in Bloomberg about, of all things, Chinese soil.
Yeah, this one's interesting. China is the world's biggest producer of soil, but right now they have a massive domestic glut.
A glut? Why?
It's kind of a perfect storm.
Yeah.
On the demand side, Chinese consumption is weak. People are eating out less, so restaurants need less cooking oil. On the supply side, they have very robust soybean imports.
So they just have way too much of it.
Way too much. Commercial stockpiles hit a 7-year high in mid-November.
And what's the solution? Find somewhere to dump it.
Exactly. And that somewhere is India, which happens to be the world's biggest soil importer. China shipped a record 70,877 tons there in October.
So what's the competitive advantage? Why would India buy from China instead of their usual suppliers in, say, South America?
It comes down to two things: price and speed. The Chinese soil is trading at a discount, about $10 to $15 cheaper per ton. But the crucial part is the shipping time.
How much faster is it?
It's dramatically faster. 10 to 12 days to get to India's east coast from China versus 50 to 60 days to ship it from Brazil or Argentina.
Wow. So China is basically solving its own domestic problem by flooding the Indian market, and in the process, they're disrupting traditional global trade routes.
That's the long and short of it. It's a big story disguised as a simple logistics update.
Okay, before we wrap this up, let's hit a few key corporate stories that are making headlines this morning.
First up is Zoom. They raised their annual profit and revenue forecasts after a really strong third quarter that beat estimates. They brought in $1.52 per share versus the $1.44 that was expected.
And they were pretty clear about what was driving that.
Very clear. They credited the strong momentum directly to their new AI tools, specifically their custom AI companion. It's more proof that if you're a legacy platform and you successfully integrate AI, you get a real performance boost.
We also saw some movement in the S&P 500.
We did. SanDisk, the flash storage company that was recently spun out of Western Digital, saw its shares pop up to 9%. That was after S&P Dow Jones announced it's going to replace Interpublic Group in the S&P 500 index.
And finally, Jim Cramer's take on Six Flags.
Yes, which was colorful. He admitted the stock requires incredible patience. There were operational issues, broken rides, delayed openings, plus macro headwinds.
But he was optimistic about the new management, and he cited a very unique potential catalyst.
Right. The unexpected influence of Kansas City Chiefs player Travis Kelce, and specifically Taylor Swift's legion of fans. The idea being that their celebrity association could actually drive tourism to the parks.
It's a strange world when celebrity relationships become a factor in a corporate turnaround thesis.
It really is. So to bring it all together for you today, the three central tensions we've covered are pretty clear. First, you have this intense AI chip rivalry heating up, challenging NVIDIA. Second, you have institutional money just flaying the crypto market. And third, you have these delicate geopolitical balancing acts, especially the China-Japan dispute, injecting real uncertainty into trade.
It's a market with a lot of very fast-moving parts. And for our final thought, let's circle back to that speed of innovation in AI. We talked about Anthropic's powerful enterprise models, and we talked about this promise from Jony Ive and OpenAI for a new kind of hardware with a calmer vibe.
A device meant to replace the constant distraction of the smartphone.
Exactly. So here's the question to leave you with. If the main way we interact with computers really does shift away from that competitive, screen-staring Times Square ecosystem and toward a calm, always-on AI companion, how quickly will the entire consumer hardware market change? And which of today's trillion-dollar giants will be left scrambling to catch up?
That potential pivot. It's the biggest threat and the biggest opportunity of the next decade. The implications are just staggering.
We'll see you all tomorrow morning with new headlines from major financial magazines.